Yeah, hello.
Hello, hi everyone. Welcome to today's session. This is number 1 of 3 episodes that MEST Africa will be hosting on fundraising and startups in Africa. My name is Leila, and I'm the head of marketing and community here at MEST. I will be moderating today's session. So before I go on to tell you who we are as MEST and what this program is about, I think we can start getting interactive. I am calling in Accra, Ghana. I'm calling from Accra, Ghana. It's exactly 12:02 here. So wherever you are coming in from the world, just drop your location, drop your name. Let's start getting interactive. Let's know where you're coming in from, you're joining in from, and let's have some fun today and get to meet new people. So you can, if you're a startup founder, tell us what your business is, drop us a link to your website. This is a place to build some good network, and you never know which investor may be also looking at you. Hey, so yeah, welcome once again. Okay, so if this is the first time that you're hanging out with MEST or hearing about us, you should know that we're a Pan-African program that has trained over 600 tech entrepreneurs and funded over 80 startups in Africa. We also operate out of Ghana, Nigeria, Kenya, South Africa through our hubs. So do visit meltwater.org, that is meltwater.org, to learn more about opportunities that we offer the entire African startup ecosystem. I'm pretty sure you find something that suits you. Awesome. So why are we here today? If you are a founder or an investor or someone who's just generally interested in the tech and startup space, and you've been paying attention to recent funding announcements, you will realize that, of course, there's been some increase in deal sizes, some of which have catapulted startups to billion-dollar evaluations. And if I should borrow the Silicon Valley term, into unicorns. The interest in African markets, obviously, and its startups are growing. It's definitely growing. And we see this in the number of startups that are also being funded, as well as the increase in deal sizes. It's definitely an exciting time for the continent, for businesses, for investors. And over the next 3 days, we will be delving into the growth trends to understand the factors behind this, the factors influencing this growth, but most importantly, how startups and investors can position themselves to make the most out of this. We will be speaking to African startup founders, investors in African businesses, and other organizations in the ecosystem. Super. So on today's episode, let me just dive right into today's episode. I have with me 2 gentlemen with loads of experience and insights when it comes to fundraising in Africa. So there's Joshua Murima. Sorry, Joshua, I just murdered your surname, who is the head of ecosystem and engagement and investor relations at Briter Bridges. Hi, Joshua.
Hey, Leila. Hey, everyone. Good to see you. Good to be part of this episode today.
Thank you for joining us. Tell us about Briter Bridges and the work that you do with the various players in the space.
Sure. So I'm based in Nairobi, so calling in from Nairobi. And I lead ecosystem engagement, as Leila has rightly put it. Briter Bridges is loosely a data-driven research firm that has existed for the past 3 years. And our mission, our mantra has always been to showcase, the brighter sides of these emerging markets, including Africa, Latin America, and South Asia as well. We started off by way of being a magazine that literally, provided digestible pieces of information, and by this I mean literal maps, infographics, visuals that people have come to love. But we've grown as a publication, and we release regular flagship publications such as the Africa Investor Catalog, the Africa Investment Report, and other thematic publications like a recent gender financing report that I guess we are also going to sort of talk about. So that's what we've been doing, pretty gone really fast in the previous years. And, happy to share what we've been learning, especially when it comes to investments and financing for early stage founders in the continent.
Yeah, awesome. And I must say that Briter Bridges and Joshua here, they have some really, really insightful numbers to share with us today. I'm very sure that you'll be very, very excited to see these. The next speaker who is yet to join us is Zachariah. Zachariah George, who is the managing partner of Launch Africa Ventures. Launch Africa Ventures has actually been recently named as one of Africa's most dedicated investors. So they have over 44 deals in 2021 alone. And I'm pretty sure immediately Zach joins us on the call today. He will give us some more insights on that and his work. So, just to give us all an idea of what today's session would be like, let me just quickly share my screen again. So we would have a panel discussion where we will go through these data sets and charts that we put together and very, very insightful numbers in the past few years, including 2021. So we mostly will be looking between 2018 and 2021 to see the trends, what's been happening, what's influencing the space, the changes, the exciting news and all of that. And then we would also interject with a very interesting audience poll to get your feedback and your thoughts on some of these topics we'll be treating. Then we would go into a very, very engaging question and answer session where you would be able to ask our panel questions and get answers to. So in light of that, I would suggest that as the conversation is going on, or if you already came onto this show with a question, please drop it in the Q&A feature there, right down on your Zoom screen. Just drop your question, and as the conversation is going on, kindly put any other question that comes to mind, anything that you want clarification on, more information, and our panel will respond to it as we get to that session. So thank you very much for your attention so far. Like we said, we have Joshua Murima on the program today, and then Zachariah George. Next, I just want to give a disclaimer, and I'm sure this is something that Joshua would also do as he takes us through the data, that all the data that we will be sharing on here today are based on announced deals only from Briter Bridges. Thanks for the support once again. So on to the first one, and I would like Joshua to assist us here by taking us through and telling us what we see when it comes to the growth of disclosed deal volumes in the African continent from 2019 to 2021.
Sure. So as we all probably know, the African tech ecosystem has grown in leap and bounds. The reality as it stands is that over $3 billion has been invested in African tech startups in the year 2021 to date. This is testament to the growth that the space has seen over the year. We are seeing a greater focus on B2B products, and this is also sort of driving the investment volumes and figures in a way that more B2B startups are raising huge amounts of funding. We are also seeing that there is some sort of a move from business to consumer or customer, that is B2C to B2B. For example, in the fintech sector, the space is sort of morphing away from the micro loan model if you think about the TALAs, the branches of the micro loan, fintech lending space, and moving towards product models such as personal asset finance and buy now pay later, which is a new kid in the game, which is a new trend. And a classic example to this will be the likes of Carbon, who literally moved from B2C lending to more buy now pay later personal asset types of products. We are also seeing the bundling of products in the sense that startups are coming together to partner. Startups operating in different sectors. We're seeing a lot of demand aggregation, a lot of embedded products, and most logically, as between startups that operate in the finance and fintech sector, as well as the other sectors. So a lot of bundling of finance products and say healthcare products in the sense of healthcare finance, insurtechs that is in the logistics space. In agriculture, for example, crowdfunding for farmers. And what this means is that the lines are getting blurrier. So what should be noted, though, is that in 2021, we are seeing less of disclosed mergers and acquisitions, that is M&A. And what we saw last year is that M&A actually took about half of the total disclosed funding volumes at around 1 billion, right? What we are seeing right now, or the year to date, is that a huge portion of this financing is made by way of direct equity investments or debt investments, and so on and so forth. As you can see from the graph, there was some sort of a dip from 2019, 2020, arguably because of the effects of COVID, right? So the world is, sort of going back to normal, which could be seen as the new normal now. And the reason as to why the funding volumes were in some sort of a bottleneck last year is because of liquidity issues. So investors sort of held back on their investments to sort of look at how the market performs. And now that the world is sort of going back to normal, we're seeing investors deploying that cash was sort of held back at that time. Also, a possible reason as to why there is a steep rise in investment volumes in this particular year is because of the recent success stories, right, that we've been seeing. Again, a lot of exits, be it by secondary trade sales, a lot of exits by way of acquisitions, and a couple of IPOs as well. We're also seeing that successful founders are sort of paying back to their fellow early stage founders. So, for example, just today we saw the Union 54 deal where the Kuda Bank founder participated in that deal as an angel. Recently, the Brass financed 1.7 million deal. We had both the Paystack and the Flutterwave founders participating in those deals. So, in a way, we are seeing more successful, experienced founders participating in deals, and that also has an effect into the overall, disclosed deal volumes. Yeah.
Interesting, very, very interesting insight. Something that I want to just point out is the dip that we are seeing here in 2020. How did COVID play a factor in this role? If it did.
Yeah, for sure. So as mentioned, there were liquidity issues last year. So there was a lot of uncertainty in the sense of investors not being sure, investors and founders not being sure how the space will perform. Investors kind of took a break from sourcing new deals and sort of also focused on on their existing portfolios, right?
Yeah.
So they sort of held back from deploying new capital, right? And that's also the reason as to why there's a sharp rise in the amount of investments this particular year, because there's that liquidity that was held back last year that investors are trying to deploy for the year. So I mean, COVID had an effect clearly the investment volumes last year, but the space is now more resilient than ever. Yes.
So we have Zach on with us now. Hello, Zach.
Hi, Leila, and hi, team. Sorry for the delay in getting on, but better late than never.
Yes, so we did a brief introduction before we go on with this, Joshua and the rest of the audience. We did a brief introduction of who you are and your work with Launch Africa Ventures, but we want you to tell us just a little bit more, and then we will go into continue from where we left off.
Yeah, just very briefly looks like there are 100 plus participants on this call. I'm based in South Africa for now. Was one of the founders of Startup Bootcamp, which is one of the largest accelerators in the world. My co-founder Philip and I started the Africa chapter of Startup Bootcamp in 2016. I'm an ex-banker, was at Lehman Brothers and Barclays in New York for many years before moving to Africa in 2010 and building incubators, accelerators, and venture building studios for about 6 years. And then about a year and a half ago, well, almost 2 years ago, we started the process of launching a Pan-African seed fund called Launch Africa, which is now in its sort of 12-month anniversary from an operational standpoint. And we're one of the most active VC funds on the continent.
Yeah. We've
been friends of MEST for many, many, many years. In fact, MEST and I go back 2013, 2014. So several graduates from the MEST Accelerator Program Incubator eventually got into Startup Bootcamp, and we've invested as Launch Africa in some of your portfolio companies. So we strongly believe in the power of the work that incubation programs like MEST do for our graduates, from an access to networks, capacity building, POCs with large corporates, and of course, eventually from an investment standpoint. So
great stuff, great stuff. Thank you so much. Thanks, and thanks for also making it in time for this. So Joshua was just taking us through this slide here where we look at the growth trends from 2019 to this year, currently where we stand at. And you do see a dip, of course. He's explained that, because of COVID, there was a lot of holdback on funding. And then this year, there's a lot of liquid to be given out. Beyond that, what do you find is also influencing investors like you to be more confident in African startups, first off?
Yeah, I mean, just to be very clear, investors like ourselves, we've been in Africa for 11 years, right? So it's not we're sitting in New York or Paris or London or Bangalore investing in African startups. We are very much on the ground. So for us, investing in Africa is investing in our home country, continent, for lack of a better word. Yeah. So quite a few things. One is there's very little smart capital that goes into startups in Africa pre-Series A. So at Series A, you've got some very smart global VC funds and funds on the continent that come in. There are several, I don't need to mention names, but there are probably at last count close to 500 VCs that actively invest in Africa. Yeah. But it's mostly at Series A, Series B, Series C, and beyond, right? At seed, most of the capital tends to be friends and family and angels. The angel network in Africa has gotten a lot better. You've got local angel groups, you've got regional angel groups, and you've got continental angel groups. But angel money alone is not sufficient, right? Because angel money tends to not have a lot of strategic value add outside of just capital. So there are a few VC funds that come in at the seed stage, but it's more opportunistic. So they'll take a bet on a company, but it'll be a very small part of their portfolio. So most VC funds will allocate, maybe 20% of their entire AUM into seed investments, and they'll reserve the bulk of their fund for follow-ons, right? So us as a fund, we took a contrarian view to it. So we said we are an exclusively pre-seed and seed fund. So we back companies coming out of world-class accelerators and incubators such as yourselves. And we're providing institutional capital where previously you only had retail investors. So we're helping with introductions and POCs and pilots with large insurance companies, retailers, telcos, banks, etc., which is something that founders at that stage really badly need, instead of waiting 2 or 3 years until they get Series A funding. So yeah, that's why we're excited. Also, valuations in Africa at the pre-seed stage and seed stage are still fairly undervalued compared to global averages. So that sort of arbitrage, if you may call it so, exists, and it will not last for too long. So we think it'll be another 2 or 3 years at the very most before this happens. But don't get me wrong, as a fund, Launch Africa is we're a very active fund, but you're also very, very selective. We look at about 600 to 700 deals every year, and we've done 60 plus investments so far. But unless there's a proof of concept, unless you're generating at least $20,000 in monthly recurring revenue and have partnerships with large corporates as a channel distribution network, it's going to be very hard for us to invest in you, because we typically invest to see a minimum of a 5x return in 2 years. So we're very selective of who we invest in. But once we do go in, we bring the whole, we throw the proverbial kitchen sink at the companies that we invest in.
Yeah, you did mention that for other foreign, if I should use the term, or global VCs that are outside of Africa, there may be a bit of a bias in evaluating African startups. Why do you think so? Are there some key reasons that you can quickly give us? And is with this trend that we are seeing, is it possible that bias, or it's beginning to get minimized, and what's influencing that as well?
Yeah, listen, I don't think there's a bias in terms of, I'm not sure what you mean by bias, if it's from a valuation standpoint or if it's from a...
So the way basically African startups may not be valued as much as a global competitor. Why is that so?
That's not true at all. I don't know where people come up with these stats. That's not true at all. If you look at look at the top e-commerce, logistics, digital banking, insurtech startups in Africa, and compared to their peers in the US, there is no discount. So I strongly disagree with that statement. What I do agree with is at the seed stage, there is a valuation gap. Completely agree. But once you're at Series B or Series C, there is no difference, right? And we've seen that. The key thing to understand here is you have to compare valuation to underlying metrics. Right? So it's easy to say, listen, why is Revolut valued at, $40 billion? Why is Nubank valued at, I'm just giving an example of digital banking, of at $35 billion, and how come there isn't a digital bank in Africa valued that highly? Well, the answer is very simple.
Yeah.
Nubank has 25 million customers. Give me one digital bank in Africa that has even 5 million customers.
Yeah.
Right. So if you have your underlying metrics, you will get value. Kuda Bank was one of the first investments that we made as an accelerator, startup bootcamp. They did a Series B round at a valuation of $500 million. But at the time, they had 1 million customers. So that's a $500 per customer valuation, right? Which is pretty much the same, at least at ballpark, $500 to $1,000 for digital banks across the world. So once you have your underlying metrics, be it number of users, be it transaction volume, be it gross merchandise volume, be it revenue, be it net revenue, the multiple that you get from a valuation perspective has to be in sync with your underlying traction. When you see African startups show traction, they will have high valuations, right?
Yeah.
Why is Flutterwave valued at over $1 billion? And it probably is valued at far more than $1 billion. It's because they process, several billions of dollars in transaction volume every year, right? And they're a 7-year-old company, right? And they make about, I think last year when they did the Series C, they were doing about $25 million in net revenue every year or thereabouts, right? So that's valuation follows traction. So when people talk about this Africa discount, I strongly disagree with it. In my opinion, it's a cop-out. It's an excuse to say, hey, have pity on me, I'm an African startup. I don't buy that shit. Show me traction, you'll get a valuation for it, right? If you're a car manufacturer in Ghana in electric cars, show me numbers. Show me how many cars you sold, right? So it's about showing traction, and the universe, from a VC funding standpoint, always rewards traction. So no, I strongly disagree with this Africa discount. There is no Africa discount, especially post Series A.
Yeah. Thanks for explaining that. I think that's very, very enlightening. I think we'll go on to the next slide and the next chart here, graph here, which shows top 6 sectors. So a term that you normally hear investors use a lot in the space is that we are not industry agnostic, or we are industry agnostic rather. But then with this trend, I immediately see that there's a lot of but there's a lot of traction going to fintech as compared to others. Of course, not everyone will get the same. Joshua, can you tell us a little bit about the trends that we are seeing here and how fintech is leading the space? And then we can also get your thoughts, Zach, on this trend as well.
Also, just very quickly before Josh answers, can you please make this report available?
Sure, let me go ahead.
Sorry, I was just going to say separately, could you please make this report available to Josh and I? This is a really interesting report from Briter, and I'd love to get access to it.
Absolutely, we will do that.
Sure. I'm sorry. I think I sort of had some connection problems, but yeah. So what you actually don't see here is that there are a lot of what we call outliers, right? So, for example, if we talk about fintech, you have the mega mammoth rounds by OPay, by Web, right? Which sort of push up these numbers to an unbelievable total sector volume, and the same applies to education. So those that reason Andela round at around 200 million, which in a way creates some sort of false impression that education is actually a top funded sector. The reality is that it's actually not, right? There are just a few, highly funded companies that are pushing these figures. Same also applies to healthcare with Zipline's 250 million rounds, I guess. But I mean, don't get me wrong. For sure, 100% fintech is, without using your word, that it's favored, but it's sort of the top sector in terms of investor focus with regards to disclosed funding rounds. Now, I see someone talking about cleantech. Cleantech comes at a distance fourth, and which is interesting, largely because last year, as compared to last year in 2020, we saw a lot of appetite and activity around pay-as-you-go models, around solar and mini grids. What's interesting is that is sort of slowly, gradually drying out. I mean, for facts, what I'm aware of is that M-Copper is moving away from the classic fintech, cleantech story and to a more personal finance, asset finance story, which is more of a fintech product or model. So that also says a lot about what is really happening, the changes that we are seeing in terms of the investor interest as to sectors in the continent. One interesting statistic as well is that, so far, we are seeing that payments is kind of most of the products, within these sectors are that are really receiving, the bulk of the financing, come from the fintech sector, right? Talking about payments, which is actually the leader, looking at personal finance and lending, but more predominantly B2B lending as compared to B2C. And also the neobank, digital bank story that Zach was sharing earlier on. So, I mean, we are seeing the likes of Kuda, Time Bank, Telda, Prosper, and most recently Sparkle, right? And all of these are sort of fintech verticals, which appear to be the top funded products or subsectors in the continent. We're also seeing, point of sale systems, right? More like agent banking, merchant sort of payments type of product model that is also top grossing, still within the fintech space. And then finally, solar home kits, right? And that sort of represents the position that cleantech has in the overall scheme of things.
So I find it interesting that we don't see agri-tech or even agriculture here, seeing that Africa is a heavily agrarian economy, at least for most of the countries that we have here. Is that something that you can say to explain this? Why don't we have agri as one of the top 6 sectors? Are we not innovating enough?
I can take a stab.
Yeah, I will actually ask Zach to answer that, that question.
Yeah. So agri usually gets clubbed under e-commerce and logistics. So for example, I doubt you would call Twiga or SocoWatch or Market Force an agri-tech startup, although it has a clear link to the farming supply chain, right? So people consider agri-tech as a deal where you have to specifically, evaluate land from a productivity standpoint. So there has to be an improvement, using other sensors or drones to improve productivity, to disperse agri loans. Agri-tech is a very broad term. So I gave you the example of, is a company that does, so take for example, Africa Mart in Senegal, that does farm to fork distribution, reduces the cost and time it takes to get food from a farming cooperative to a wholesaler to a distributor to a retail shelf. Would you call that an agri-tech startup? Probably not. But is it an agri-tech startup? Probably yes. So I think it's all about classifications. A lot of these startups don't get classified as agri-tech, and only a pure agri-pay like an Aerobotics, as an example, or a Farm Crowdy will be classified as an agri-tech. So part of it is just a nomenclature.
Yeah.
Secondly, agri-tech, classic agri-tech is expensive from an asset financing perspective. Yeah. So no VC is going to back you if you need to invest money into buying equipment. VCs don't fund CapEx. CapEx is funded by low-cost debt financing. So that's why if you were to add debt and equity funding, I'm sure you'd see agri-tech as a very high bar.
Yeah.
Because the IFC, the World Bank, CDC, Proparco, all the big DFIs love to do, loan on debt financing. But this, from an equity perspective, you won't see a lot in pure play agri-tech. But if you include debt, there's a lot of money going into agri-tech.
We will see a slide that also talks about, the types of deals that African startups are getting. But until we get there, another question I want to ask you directly, Zach, is beyond profitability of fintech and these top sectors that we are seeing, what else makes these spaces attractive?
I don't know who used the word profitability. It's something that's totally I don't look for. I don't look for profitable companies. I look for companies that grow quick. If I was looking for profitable companies, I wouldn't be, or you wouldn't be investing in Tesla or Amazon, right? Those companies aren't really profitable. I mean, Amazon now is profitable after 24 years, and Tesla is still not profitable, but their market cap is more than $1 trillion as of 2 days ago. So never use the word profitability when you talk about VC, at least certain types of models. What are the things we look for in companies? Gosh, we get asked this question a lot. It's the same stuff that a lot of smart investors look for. We look at strong teams. I'm sorry, there has to be a very strong, charismatic founder that really understands his or her market exceptionally well. Unfortunately, most founders don't understand their market. They are good at product, they're good at tech, they're good at a service, but they don't have a strong understanding of the market. And that's super important from a VC standpoint. So most VCs know more about your competitors and your direct and indirect suppliers than you. And that's a big red flag. So founders that have a really strong understanding of the industry and how they're going to break through it, which relates to my second point, which is understanding your total addressable market, your serviceable addressable market, and then your serviceable obtainable market, right? So going from top down, that's very few founders understand that, very, very few. And the ones that do get a disproportionate amount of funding. And then just understanding structures like IP and legals. You know, if you don't have your house in order, and this is where accelerators like MEST and incubators like MEST are super helpful, and Startup Bootcamp and YC, etc., is you learn very early on to move your IP offshore. You set up a very clear holdco, opco structure. You have your CRM systems in order. Like, VCs don't touch companies that don't have their house in order, right? And this is why a lot of startups that haven't gone through accelerators have really messy, dirty cap tables. And no one wants to get involved in a situation like that. And yeah, just traction. I see way too many startups asking for huge amounts of money, and they don't even do $20,000, $30,000 in revenue a month, right? So I almost say, like, how dare you ask someone for money when you haven't proven your traction, right? So yeah, these are all factors that we look at. But you know, when you invest early on, unit economics is super important. So you got to understand like how your LTV to CAC ratio, so it's your lifetime value to your customer acquisition costs, how does that change over a period of time? You look at growth versus churn. You know, how fast are you growing your customers versus how quickly are you leaking customers? What percentage of your customers are recurring users? What percentage are dropping off? Like, these are all things that you have to keep tabs on properly. How do you refer customers? How do you incentivize customers to refer more customers to you? What is your viral coefficient, for lack of a better word? So yeah, there are lots of things that we look at, but unit economics, probably the most important thing.
Great.
We look at, yeah.
Thanks for those notes. I hope our first-time founders really got the notes on those key points. And the next one is the trends in country. So yes, Nigeria is leading the pack. Rumors are true. But yeah, these are very interesting markets. The most announcement that you hear a startup make, it's usually from these markets. But I want you, Zach, to tell us a bit more. What do you think that these countries are doing right to enable, you know, their startups to grow and to attract investors, if at all?
Gosh, the simple answer is people. I should be careful of what I say on these forums. People make a lot of babies in these countries.
Wow. Okay, so population is high, and
Population is very high. I mean, Egypt has 120 million people. Kenya is at 60. South Africa is at 60. Nigeria is at 220. No, that's the funny answer. But the reality is, people look after big target markets. You know, I mean, the US has 300 billion people, but the economically active portion of those 300 million people is very, very, very high. You know, Nigeria would not have gotten any. I mean, Nigeria was an unheard of country from a VC perspective as little as 6 years ago, but the economically active portion of Nigerians has gone up by leaps and bounds. Right? Egypt has 2/3 of the Egyptian economy is completely informal, right? And economically active. The cost of data is dropping significantly in these countries. The number of individuals that are that have a smartphone is high. The purchasing power of these these populations has gone up a lot higher. So these are all factors that that make them hotbeds for innovation. Yeah, but probably just population and economically active. So, for example, a good case is here. Ethiopia has the same population as Egypt, but why is Ethiopia not on this map? Well, it's a very restrictive government. There isn't much access to the internet. There isn't a big smartphone penetration. There isn't a digitally active population in Ethiopia. So that's a good example of where population alone isn't going to help you, right?
Yeah.
Yeah, in the DRC, the DRC, what is the DRC's population? Does anyone know what the DRC's population is? It's probably higher than South Africa and Kenya, but they're not on this map because they don't have an economically active population, right? And a digitally active population. So population is one part of it, but the amount of the consumer purchasing power and the percentage of the population that's economically and digitally active and online is another big factor.
Yeah, awesome. Thanks for that. Let's go on to the next one. It's a very, very, very interesting one where we break things down in terms of gender. So this, I'll let Joshua quickly tell us, why do we see this trend of funding that's going to all female startups just reducing year on year? What did you find in this particular research?
Well, there are glaring gaping inequities when it comes to gender and kind of the supply of capital to the genders. Now, why that is happening, this is often an emotive, controversial topic. But what we found from the 170 or so conversations that we had with female and women founders was that there was less representation of women founders in high growth, well-funded verticals, like look at fintech, right, and so on. So this had some sort of an effect on the overall sort of optics of the representation again of women in these stats, right? So what we see is that women are underrepresented in high growth sectors such as fintech, etc., and also in some verticals and spaces that are seen to be irreceptive to the involvement of women founders in them. So, typically speaking, logistics, right? There are also less, women founders working within those areas. So that, in a way, also feeds into, the gender gap, the gender financing gap that we are currently seeing.
Interesting. So at this point, I would stop and then hear from the audience. We have a very, very interesting poll, still on the same trend that we are seeing here on gender and then the funding that the various genders receive. So let me just stop my screen for a second and then share a quick poll to hear from our audience. So the question is, let me launch this. the question is, what should be done to enable more female founded startups to receive more funding? So let's hear your thoughts on this. Should there be more female investors? Should we encourage women to go into sectors like fintech, like Joshua said? These are the sectors that are attracting more investment lately. Or should all investors should be intentional? Should they be intentional about supporting female-founded businesses? Or do you think, I think the status quo is fine and nothing needs to be done? What are your thoughts? Let's get the votes coming in. Nice. So if you have an additional thought on what should be done, please do drop it in the comment section. Or if you want to ask panelists on specific questions concerning this poll or this particular trend, please drop it in the Q&A session as well. Please feel free. More votes coming in. But just as the votes are going on, I want to hear your thoughts. So Zach, as an investor, how do you feel about this chat?
Yeah, listen, there's definitely a need for more female funding in female-owned ventures receiving funding. I mean, it's quite shocking how little money goes into female-founded startups. I'm always a big fan of diversity in multiple ways. I mean, diversity is not just gender. Diversity is gender, it's race, it's nationality, it's age, it's everything. For example, in Africa, the average age of a founder of a tech startup is between, sort of 35 and 50. Because most people on the African continent have this need to work at a corporate for 10 to 15 years to get enough experience, save enough money to use their savings to bootstrap themselves, right? So there's this, you don't have the luxury of starting a startup at the age of 25 like you do in Silicon Valley or in London. So yeah, I mean, gender inequality in the VC world is a super important topic that needs to be addressed, right? Personally, from a Launch Africa perspective, I'd say close to 25% of all our investments have a woman co-founder at least, or women in senior management. One of our sister funds that we work with very closely has an exclusive mandate to only invest in women-led startups in Africa. They call 535 Ventures. But, it's also important, and this is maybe, I saw Louise in the chat talk about, Zach, to not be, to lay bare and not really put filters and careful what do I say. The reality is, where are all the women LPs? Where are the women angel investors? I mean, the shocking, no one talks about this. A woman angel investor and a woman LP in a fund is 10 times more likely to back a male funded startup and a male run fund manager. So I'm going to call out the hypocrisy here, right? Why are women not backing women? Women are majority backing male-led startups and male fund managers. So that's something we need to talk about, right? There are plenty of very high-powered women who work at McKinsey, Goldman, Merrill Lynch, MTN, Vodacom, Sanlam, Barclays, Standard Bank that earn good money, and they invest their money into male-run startups. So I'm going to call out the hypocrisy here. I know us men have a lot of work to do, and our fund is making a clear step towards it, but I want to call out the hypocrisy from women investors as well. They should be backing women-led startups as well, and those numbers don't lie.
Yeah, but in your experience, the spaces in which these female founders are, it does play a role into they receiving funding, or would you encourage the just as you encourage more female investors to invest in female businesses, would you also encourage female founders to come more into these spaces where there's more funding?
Of course they should. I mean, they should. Of course they should. I mean, funding needs to be democratized. Yeah, listen, I don't want to comment too much on this. I mean, absolutely. I think me personally, I'm a single parent to an 8-year-old daughter. I am the mom and the father of my child. I do everything that a woman does, except I can't physically, breastfeed my child. But literally apart from that, I do everything. I take her to school. I do everything. I go to play dates, sleepovers, bedtime stories. I do all of that, and I run a fund. There's no excuse. You can't this excuse that women have to be homemakers and that prevents them from running startups. I don't buy that. Okay. And I can speak for myself. I do everything that a mother should do, and I run a fund, and I support. So no, we cannot use as excuse that women have responsibilities at home, therefore they can't run startups. No, this is 2021. You should be able to multitask. Yes. Men do it. I do it. No.
Yeah, and I'm sure Joshua, I don't know if the data said anything about women multitasking preventing them from investing or going into those areas. I'm not sure the data says that, does it?
So actually the conversation needs to move away from that, right? Away from, the gentrification, or rather, stereotypical perceptions of women roles, and move to, more strategic types of solutions to solve for this gap. So for example, as Zach mentioned, there are more, sort of women-focused funds that are cropping up, Fast Check Africa, Weak Capital, Equity, those in a way are making their contribution. But we also found that, traditional biz training is unlikely to solve for the inequity. I know someone mentioned that probably women having more women founders having started, within the sectors that are well-funded, which is fine. But, traditional biz training and mentoring won't solve for it. One of the perspectives was that women founders are more over mentored and over supported than their male counterparts, right? So what I see is that there's more need for, I would say technical training, especially in engineering and STEM fields, right? To build these technical capacities of the women founders and really lead some of these startups that are again more well-funded and highly grossing in the market so far.
Yeah, definitely a very sticky topic and very controversial, like you said. Let's see what our audience voted for. Okay. So you can see this on your screen now. So we have 57% saying all investors should be intentional about supporting female-founded businesses. Then we have 28% saying encourage women to go into sectors like fintech. And then 12% saying there should be more female investors. So Zach, you have supporters behind you on that point. And then 2% says nothing needs to be done. The status quo is fine. Thanks so much for that. We do have a very limited time. We had one more slide to show, but I think it'll be a good time for us to go into the question and answers. So I will read them here. So in the Q&A session, Claiborne Apis, I hope I got your name right. I'm sorry if I killed it. Access to markets remain a great challenge for African startups, even when we have solved a global problem more comprehensively, but yet experience this challenge. How do we address this, as it is very often, how do we address this as it very often could solve the problem of capital at the same time? Zach, is this something you would want to respond to? I hope I got the question right. It doesn't read very clear.
Yeah, it's a pretty long, convoluted question. Would you mind giving me the exact, like, what is the exact question? Because it seems like there are a lot of questions in one.
Yeah,
So,
so Clayton is.
if I can
What would
actually
you wanna-
jump in right there, I think it also relates to what you said, Zach, about having channel partnerships, right? So, he's asking about, access to markets, right? So how do we actually, address that problem, as well as the problem of capitalists at the same time?
Yeah.
Yeah, I mean, do you want my thoughts, or I mean, like I've mentioned this earlier, like many times. If you can't lower your customer acquisition costs, and one of the quickest ways to do that is through partnerships with entities that control distribution. And the reality is, distribution to a large extent is controlled by telcos because they have access to data, customer data. Number two, banks. Number three, insurers. And number four, retailers, right? So if you don't have distribution partners, and that's what channel partners are all about, it's very hard for you to scale. A lot of founders want to hold on to equity, they want to hold on to margins, and they forget about the bigger picture of growing the size of the pot versus having a lot of a very small pot. Right. This is the problem with founders of a lot of tech startups in Africa, is they want to hold on to equity. And they also want to hold on to margin. So if you're making a margin of, I don't know, 35% on whatever you sell, a lot of founders will blatantly refuse to share that margin with anyone else. While at the same time, you may have a telco, a retailer, a bank, a manufacturing firm, a retailer, or an insurance company that could give you access to hundreds of thousands of customers, provided you have a licensing agreement or revenue sharing agreement or some sort of a commercial partnership with them. And very few founders engage with large corporates, which could effectively lower their customer acquisition costs from early on, right? So that's one of the things that we see happen very often, is founders just don't understand the concept of truly sharing in the ecosystem. And that applies, by the way, also to scaling outside of your home market. If you're a startup in Ghana and you want to expand in Nigeria, you don't need to set up an office in Lagos. You need to find partnerships where you share in the revenue, where your technology gets licensed, but someone else distributes, and you open channel partnerships like that. And that's the short-sightedness, about scaling, that we should be changing.
So we have Jill Lagos Shemin, and Jill says, "I love it if you could discuss the problem of VCs' expectations for growth and pace of growth in the African context." Is there a problem, first of all, with, if Jill, you could state specifically what the problem is here? I wouldn't want us to make assumptions. So what problem do you see with the expectations of VCs, or what are the expectations of VCs in terms of growth and then the pace of growth in the African context? Thanks for that. How do you, Sir Munira Sheikh says, how do we succeed in channel partnerships?
Yeah, I've actually answered Munira's question about channel partnerships, or more about, like I mentioned, you need to start working with corporates early on to reduce your cost of customer acquisition. And that's where someone like a MEST should really be helping. Accelerators have access to large corporates because they typically fund programs or fund a lot of world-class accelerators are backed by corporates. So people join accelerators for lots of reasons, but one of the reasons is to get access to corporate distribution. And that's essentially what channel partnerships are all about, right? You can't build everything just by yourself. What was the question before the channel partnership question?
So I asked Jill to specify, she mentioned that there's a problem of VC's expectations, but I don't think that's clear enough for us to.
VCs are not like banks. VCs expect to make 5 to 10 times your money within 3 to 4 years, maybe slightly longer if depending on what your sales cycle is. The problem isn't with VCs. Remember, VCs aren't investing. VCs are investing money on behalf of, several pools of investors, family offices, angels, high net worths, institutional capital, fund of funds. So VCs have I've spent hours talking about this, but VCs have to return capital to all their investors plus a hurdle, which is typically 6 to 8% over 5 to 10 years. So VC fund managers like myself don't get to share in the upside until you return typically 2 times the capital. Only then do you start seeing upside. So VCs are going to be extremely selective of who they invest in. I can tell you now, if a VC doesn't see the potential of your business being valued at 10 times or more, they won't invest in you. They just will not. And it's not that because we're evil people, it's just that because it is an extremely risky business. There are so many options, but people can deploy capital in the stock market, in ETFs, in property. And you take all these opportunities and you say, why should I invest in a private company that hasn't proven traction in Africa, that is illiquid, that has a very long time to commercialization, unless I can receive at least 10 times my money in 4 to 5 years, right? So no, I'm sorry, VCs don't have a disconnect. It's the founders that have a disconnect in what expectations they have, right? So I think a lot of founders, have you mortgaged your house to invest in your business? Have you exhausted every single channel of opportunity? How much do you believe in your company to run it, right? And if you don't believe in it that much, why should someone else?
Thanks for those points. There's a question here that I think Joshua may be able to help us clarify. So he's an anonymous attendee, he or she, and he wants to know, how would you classify a tech solution for productivity? And I guess he's probably referring to the slide on the sectors. Do we have a solution for productivity here?
Yeah, so for sure, productivity is a very nascent space in Africa. I think there's a bit of more activity in South Africa, to be particular. But in terms of classifying it, it will probably fall under software as a service and software generally, right? In terms of activity, really, what I can tell from the top of my head, it's very nascent. And that might also speak to sort of the market perception or the market need for productivity solutions, especially in Africa, given the fact that most of the problems are still in the challenges around agri, around financial inclusion, around access to healthcare and so on. It's still nascent, and apart from the likes of Breakers, who raised a $3 million round, I guess, in Morocco. It's pretty hard to properly map out the productivity space out of South Africa, that is.
Thanks for that. So Mohammed Ba says he has, for instance, if he has a scalable idea, when should he start putting plans to bring in a co-founder, and what should the criteria be? Zach, is this something you can quickly advise Mohammed on?
Gosh, it's very, very rare for VCs or even angels to back single founders. So get a co-founder as early as possible for lots of reasons, differences of thought, opinion, operations, ideas, strategy. Get a co-founder as early as possible. The ideal team size from a co-founding perspective in a lot of books is 3. So You can, a 2-person co-founder is acceptable, but the ideal number for me, at least, and our team, is 3, simply because you need someone that's really strong from a leadership perspective. So the CEO has to be the face of the company. That's everything from fundraising, investors, selling the company vision, the story, the market size, all of that, the high level person, right? A COO is a person that's very close to product and operations and managing a team, right? And then you typically need someone you have to have a co-founder that's a CTO. You have to have a, so CEO, CTO, COO. You do not need a CFO at a startup. I'm sorry. You need an accountant or a bookkeeper. You don't need a CFO is a waste of a role, right? Call them a financial director that runs your books, but so a solid startup typically will have 3 co-founders. Again, the equity does not have to be split equally, but there needs to be 3 co-founders. In certain cases, you can get away with having 2, and that's usually the CEO and the COO is the same person, but those are tough to scale. And don't give me excuses saying that my tech is outsourced. We don't need a CTO. It can work, but it's unlikely you'll get funding from a world-class VC if you don't have an in-house CTO.
Great, thank you so much, Zach. Kojo Aka wants to know if it's possible to have access to these slides. I think I'll leave that to Joshua because this is the property of.
So most of this data is actually available in the publications that we produce. So and on Briter Intelligence. So yeah, we have like the entire decade all these list on Briter Intelligence are for free. So I would say that will be the best way to access the data that we have sort of talked about in the course of this episode.
Thank you so much, gentlemen, and thanks, our audience. We had one last slide, but we have gone over time. So we would share this slide on our last episode this Friday, where we talked to Ashwin Ravichandran, Managing Director of MEST, and Lavanya Anand, who is the partner at Vested World, sorry. And just to give you heads up for tomorrow, we have a very, very interesting conversation with 2 African founders who will be sharing their experience with funding, why they went in for funding, because of course, funding is always an option. If you want to bootstrap, that's also an option. But why did they go in for funding? What was the experience? What steps did they take? What helped their fundraising process? Lots of great nuggets in there tomorrow with Paul Kwesi Damali, or CEO of Approve, and Harry Mascots, co-founder and CEO of Curacell. And this would be moderated by Emmanuel Bediakon, who is a MEST alumni ambassador, a MEST alumni ambassador, and program manager at Microsoft. I must say that this panel is an all MEST panel. Very proud of the guys and all that they are doing. Super, super, super great stuff. Thank you so much for joining us today. I want to say a big, big thank you to you, Joshua and Zach, for making time for this conversation today. So much has been shared, and I'm sure a lot of people have a lot of takeaways from this. Please, let's continue the conversation tomorrow. And then on Friday, I also want to say a very big thank you to MEST Alumni Ambassador team that helped us to put this together. Emmanuel, Lukman, and Evelyn, thanks so much. And thank you, Kafui, for also helping on the technical side. Do enjoy the rest of your week, and we'll see you tomorrow. Bye-bye.